Good evening, everyone. On behalf of Axis Bank, I welcome you to the 24th edition of Treasury Market Talks, our thought leadership initiative in the macroeconomics, geopolitics, and market space. Through this series, we aim to equip clients with high quality input around emerging issues, and have been honored by the presence of many eminent speakers in the past, notably Professor Joseph Stiglitz, Nobel Prize winner, Professor Michael Pettis, a China expert, Professor Otmar Issing, the first Bundesbank head of research, and Baroness Ashton, the EU foreign policy chief. This talk series has been received very well by all stakeholders with great enthusiasm and participation from leaders in the corporate world as well as other diverse fields. We are now in the middle of the much feared Trump trade war, which changes the tariff and other parameters on a near daily basis. We welcome today Xinxin Li and Brandon Bradford, both of the Observatory Group, to discuss how things might proceed and what the endgame might be. By way of introduction, Xinxin is Managing Director and Senior China Analyst at the Observatory Group and has served in the past as a diplomat as well as an investment manager in China's sovereign wealth fund. Brandon is Director of International Policy Analysis at the Observatory Group and in the past has worked as professional staff in the US Senate, Banking Commission, as well as in the UK's House of Commons, which you know as the lower house of Parliament. Speaking with Xinxin and Brandon is Neeraj Gambhir, Group Executive of Treasury Markets, Wholesale Banking Products, and at Axis Bank. Some housekeeping announcements before we begin. Participation in the webinar is by invitation only. We reserve the right to block any access to people to whom an invitation has not been sent. Unauthorized dissemination of the contents is also strictly prohibited, and prior explicit permission of Axis Bank is imperative. As a reminder, all participant viewing panels will be in the view-only mode. Participants who wish to ask questions may post them on the question box on your screens. Please note that this conference is being recorded and may involve the presence of the media. On behalf of Axis Bank, I once again welcome all our customers. I now hand over the forum to Neeraj. Thanks, and over to you, Neeraj.
Thank you, Tanay. First of all, a very warm welcome to Xinxin and Brandon. Thanks a lot for doing this with us and joining in today's conversation. Our topic today is Trump's trade war. What's the end game? Over the last few months, we all know that once Trump gets elected into the office, there is going to be a fresh round of discussions and negotiations on trade, the new round of trade war. We did not probably expect things to move so quickly. I think within a month of joining in the office, he has brought in a number of changes or has proposed a number of changes. Some of them are currently in abeyance, which are pretty significant. Even though during his election campaign, Trump talked about 60% tariff on China, we currently are at a stage where 20% has already been implemented. A lot of the people during the campaign trail, campaign sort of promises and campaign trail discussion thought that in his typical style, this will be a means for negotiation as far as US administration is concerned. Eventually, Trump wants to make a deal. And he's using trade tariffs as a means to get something at the end from some of these trading partners. The issue, at least in my mind currently, is that not a lot of people seem to know what exactly does Trump want, right? Hence, we have kept today's conversation topic as what is the end game? The idea of this discussion is to actually, with the help of our two commentators, figure out where this Trump trade war could head to, what could possibly the contour of things, once we are, let's say, roughly 12 to 24 months or 12 to 18 months out from now, where things could settle, and what is the shape of things that could come as a result of this trade war. Now, we all know in theory that there is a very strong argument for free trade. We call it Ricardian comparative advantage, which basically means that countries, or for that matter, any economic agent, should specialize in what they do. And if they specialize in what they do and they trade amongst each other freely, there is a significant benefit to both the parties or all the parties involved in this kind of an economic exchange. And it basically it's a welfare producing activity for all the parties involved if there is a free and fair trade. And effectively, if it is seen from a country perspective, if the world encourages, or if the global sort of economic setup encourages free and fair trade, it will effectively lead to raising living standards for all the countries. To be fair, ever since China has joined WTO in the early 2000s, it's been almost 25 years now. We have seen a tremendous change in the global trade contours. We all know that China has become the sort of manufacturer to the rest of the world. Countries like US and even India, for that matter, have actually been more effective in providing services to rest of the world. So manufacturing seems to have migrated towards China. US has become a far more services-oriented economy. Even a country like India, which has been steadily opening up its doors to the foreign capital and has been integrated with the rest of the world, has benefited from the services exports that it does. So it does feel like that there is some argument for the comparative advantage theory having benefited a lot of developed and developing economies, having played out in the last 25 or 30 years. But now there is a new set of thinking in US, which is probably the most, which is kind of most clearly, in some senses, evidenced by the much touted about essay that has been written by Stephen Mirren. The fact that probably the free trade has not been so fair on US after all. And there is an argument that as a result of this free trade, US has actually paid a heavy price. US dollar has been strong. US has lost its manufacturing competitiveness. And to name a name, China has benefited quite disproportionately. We will basically get into some of these arguments. We will see what is the merit of these arguments. I will also try and have some discussion around what could be the next step for China in this conversation, or in this, at least in this sort of trade war, because they seem to be the largest, as the largest trading partner of US, they seem to be at the center of it. We will also try and have some conversation about what it does, who bears the cost of the tariffs. Is it really the US consumer, because US is talking about imposing tariffs on its imports, or is it the exporting nations such as China who will ultimately bear the cost of these tariffs? So those are some of the questions that we will focus on today. Let me kick this off with you, Brandon. First of all, again, thank you for joining us. There are going to be short-term costs, right? And what Trump is talking about is two things together. One is tariffs on imports, and second is mass deportations for illegal immigrants, right? You could potentially argue that both of these things are going to push up the cost of doing business in US, effectively cost of producing in US. And as we are seeing recently, the markets are kind of having their own concerns about where this is headed and what impact it has on US economy, right? So the question to you, and while through your opening comments, you can probably talk a little bit about how much of political tolerance is there for the pain that this readjustment of US economy, as it being evidenced by the new administration, how much political tolerance you think they will have? How long can they play this game? And in your view, who's kind of paying the cost? What are the long-term goals potentially for US in this?
Great. Thank you very much. So the long-term goal, basically the point of all of this, is to increase the share of GDP that comes from manufacturing, and to increase the number of manufacturing jobs by the end of Trump's 4 years in office quite dramatically. So it's dramatically, it's looking to shift the economy much back, further back in time to kind of the 50s or 60s, where it was more balanced between services and manufacturing. The rationale for this is that Trump's voting base, or the original voting base, shall we say, from many, the vast majority of the country in terms of geography, not necessarily in terms of population, has really felt the negative impacts of free trade over the past 30 or 40 years. It has not been evenly distributed in the U.S. whatsoever. And so huge swaths of the country have been hollowed out, both kind of socially, economically, but not politically. The people are still there and they vote. And they hadn't voted for quite some time, and then as soon as Trump came along and seemed to speak to their interests and to their struggles, he became instantly appealing to them, and they're amongst his most devoted, voting demographic. So that's the goal. It's basically to reindustrialize portions of the country that had been suffering the past few decades from freer trade. And now, while it's very true that the country as a whole prospered quite dramatically so, and has done very, very well with the current trading system, I think there's largely been a shift in the U.S., particularly since COVID, to also have a security element to this. And so we can divide up Trump's trade agenda into different categories. So China is its own category. You can dig into that with Xinxin, but both the security hawks and the trade hawks are looking to accelerate the decoupling economically with China. But that is not only for trying to protect U.S. industries and workers, but also for national security concerns. So that the worry is that if the U.S. is too dependent upon inputs and supply chains from China, in the event that there's ever some sort of escalation, not necessarily even saying a conflict, but just a risk of escalation of negative diplomatic views, that the U.S. could be cut off and things would be in short supply, and that's just unacceptable to Trump. So these Section 232 tariffs that came into effect on steel and aluminum today, those are the first salvo in the attempt to reorient the economy to be less dependent for certain national security products on China and other countries abroad. So the idea behind these is that the U.S. doesn't have to make everything it needs in steel, aluminum, copper, lumber, semiconductors. The list goes on. It's about 15 product classes in total, but it needs to make some of all those things. One thing that most of them are not consumer facing directly. The one difference would be autos, to autos and pharmaceutical products, including active pharmaceutical ingredients. Those are the ones that are the most inflationary potentially and are consumer facing. But the idea here is that the U.S. needs to make all these things at least a little bit, and it doesn't now often, in order to protect itself in case there's any security related problems down the road. Then there's the tariffs that he's been doing on Canada and Mexico, and potentially on other countries or blocks in the future. Those are much more the president himself rather than his administration as a whole. The agenda there is largely Trump trying to force other countries to bend to his will, and there are not clear articulated goals there. There was not a rubric given to Prime Minister Trudeau and to Sheinbaum in Mexico saying, if you do these 5 things, then we're fine. That didn't happen. It's much more Trump looking to exert his will and to push other countries around. And I think because there's not an economic rationale for these tariffs in the same way there are for the 232 tariffs or the reciprocal tariffs, which I'll speak about in a second, those are more easily able to be turned on and off, especially if there's an adverse market reaction. So your question about what is the pain and what is the pain threshold, I think the voting public has a quite high pain threshold with the exception of inflation. So if there is a bit of a recession and or targeted job losses in certain regions or in certain sectors, or the stock market's down for a while, the stock market's not the real economy. It's not the real America. And yes, people do have their retirement tied up in a 401k that's often invested in the market. But generally speaking, inflation is much more pernicious for the average American, and something that's fresh in their minds from the Biden administration. And it's part of the reason that he lost the election to Trump. So I think that the most important arbiter of the public's pain tolerance is inflation, not decreased economic growth or market downturn. Now, Trump's what is Trump's limiting factor? I think the market downturn is much more limiting for him. Although it's more important to focus on the bond market than on the equity markets for Trump. That's a bit of a change from last time around. In his first term, he was very concerned with the S&P and how equity markets were performing. I think that's slightly different this time, partially based off of different advisors that he has around him during this term. So there is a high threshold, but it's not going to be continuing forever. And also, he can adjust things as he goes along. So the least likely to be changed, the 232s. Then there's reciprocal tariffs that are coming out in April. There's two different versions of reciprocal tariffs. One could be that it's just tariff for tariff, and the U.S. would say, okay, if country X has a tariff on this product, if you bring it down to the U.S. level, then we're fine. And then everyone has a lower tariff and trade can continue at a faster clip. If the country won't, then on that product, the U.S. will increase its tariff to meet that country. I'm convinced that for most big trading partners and for most products, not all, most countries will want to negotiate and bring them down to the U.S. level. Now, the problem is, what do you do with non-tariff barriers, including VAT? And here is I think the biggest decision point that Trump has in the next few weeks, and it's that market participants should be focused on acutely. And that is, if he chooses to include VAT in early April, percentage for percentage as a tariff, then he is deadly serious about going all the way, and his tolerance for pain will be extremely high. And we're in for a very bad time for the next several months until things really inflict pain upon the U.S. public and Trump changes course. But if he takes this market downturn as a sign that maybe he's going a little too hard, too fast, he can still do the reciprocal tariffs, but do a study on the use of VAT or do something more sophisticated on non-tariff barriers that is not using a tariff. So it would be saying, okay, if you tariff our, if you have prohibitions on taking U.S. agricultural products, we'll have prohibitions on things that have agricultural components from your country, and they do quotas or do bans or something like that. That's far less inflationary. It's still disruptive, but it's less inflationary, and probably the global markets would breathe a sigh of relief. So that's the number one thing that I'm looking for the first week of April is, have they gone all the way to the most extreme version of reciprocal tariffs, or has it been dialed back because of the turmoil? So I'll pause there. Thank you for bearing with me, but it's good to get all out the first.
That's a very wonderful insight. I think I didn't think of the importance of VAT and those non-tariff barriers in this entire conversation. I think all of us seem to be very focused on customs duties and import duties, but VAT is obviously a very important play in all of this for many, many commodities. I think somebody was asking me that even if India were to cut the tariffs on, for example, import of cars, what will we do about VAT? Because we impose VAT on imported cars as well. So I think, yes, that's an important element. There is a lot in the points that you talked about to discuss. But before I go much deeper into the US and the rest of the world side of the story, I also would like to get Xinxin into this conversation. Xinxin, once again, thanks for joining this. This couldn't have come at a better time, or rather a worse time than for China. We are seeing a significant slowdown in growth. There are structural problems in Chinese economy around, real estate and the local government debt. Of course, Chinese leadership has been very, very measured in terms of the support they have been providing to the economy. I think they've been very targeted. Xi Jinping has been very, very focused on, bringing in a lot of high-tech industrial leadership into China. I think they seem to be extremely focused. The recent conversation between him and the tech giants CEO seems to be indicating that things are thawing up. There was a bit of a cold winter there. So, how do you, given all this backdrop, how do you see this story play out for China? I mean, if one were to go by the argument that Trump is ultimately looking for a deal, right? There is a lot between US and China here that needs to be worked out, right? There is large trade deficit for US. There is, the whole geopolitical angle. There is, the Russia angle, the European angle. So how do you tie all of these things together in this trade war?
Well, thank you so much for having me here. It's a great honor and pleasure. As you mentioned in your introduction, US and China have been in the deep and broad economic interdependence over the past 3 decades. Now you can see that every structural issue on the US side, such as low saving rate, overconsumption, and a huge trade deficit, you may find a mirror image on the Chinese side, such as excess of saving, overinvestment, and a huge trade surplus. To some extent, we can describe this current trade war between US and China as a economic decoupling. In other words, it can be viewed as an economic divorce. For what type of divorce is painful. But there are still some ways to manage this economic divorce relatively smoothly. And I think for China in this trade negotiation, the Chinese leaders have both a strategic goal and also a tactical goal. The strategic goal is to prepare a complete decoupling, including a potential geopolitical clash with the United States, especially in East Asia. We can touch upon that topic as well, especially the Taiwan issue. The tactically, they want to make this economic decoupling as smooth as gradual as possible, because China is not on the offensive side this time. They are on the defensive side, and they start to realize that this economic decoupling has become inevitable or even irreversible over the past 6 years. And actually, the total the share of the China's export to the United States in China's the total share of the exports has already declined by about 5 percentage points over the past few years to around 14.6% last year. So it has already happened to some extent, this economic decoupling or divorce. But now with the new round of the tariffs, you mentioned the Trump has already imposed 20% additional tariffs on China. Whereas other tariffs on other economies, such as Canada and Mexico, have been suspended or postponed. So it seems that China is still the #1 target of this trade war. And for this very surrounding issue, you mentioned that this comes as a bad time for China. And that China needs to have a very calm but a strategic approach to deal with Trump's tariff. At this moment, I think China really has the two-hands approach. On the one hand, if the US side wants to talk, the Chinese side is also ready to talk. They honor the previous deal, the so-called Phase 1 agreement both sides reached in early 2020. And that basically means they are ready and willing to buy more US products, including energy and agricultural goods. That's something they can put on the table. In addition, they have some other bargaining chips. For example, they can put in more and a stricter control of the export of fentanyl and fentanyl precursors. This is one of the major requests from the US side. And the third one is they can offer the better market access for the US companies to come to invest in China. They can also offer more investments of Chinese companies in the non-critical areas in the US. And even for the RMB exchange rate, I think it could be part of the negotiation. and under the so-called Plus Accord 2 or Mar-a-Lago Accord, I think the Chinese side can tolerate a moderate appreciation of RMB. So this is what they can offer on the, on the Chinese side and in the potential trade agreement. And what could China retaliate if tension escalates? We have already seen that China have imposed retaliatory tariff. It's not going to be dollar for dollar, one-on-one retaliation. But China will target those strategically important sectors for the Republican Party, for President Trump, especially those agricultural states. So agricultural goods, this is a big target of China's retaliatory tariff. In the meantime, China can impose more export controls of critical minerals, especially rare earths. And the third one is more investigation on the U.S. companies to add more U.S. firms on China's unreliable entity list. And also they have announced a anti-monopoly, antitrust investigation on companies like Google. So this is something they have already announced. And I think there are two other potential tools they haven't used, but it's a potential, this is some measures they can use in the future. The one is to allow more RMB depreciation. The last one, but I think at this moment it seems quite unlikely. This is really the retaliation of the last resort, is to sell off China's holding of the U.S. Treasury securities. So let me take a pause here. If there's any question,
that's a very wide spectrum of outcomes that one is looking at, from RMB appreciation and trade deal with US to a RMB depreciation as a retaliatory measure. The possibilities are quite wide, right? But let me ask you as a follow-up question. I think there's a lot of chatter in the market that we might have a Trump-Xi Jinping summit somewhere in April or June, right, where these things will come to a head. And what is talked about is Trump traveling to China to meet with Xi Jinping. What do you think is the possibility of that? Do you think April or June are these realistic timelines for both the parties to actually come to a conclusion? Because the objectives seem to be very diverse, and there is a lot to negotiate in a way.
Absolutely. Just 2 days ago, both in the Wall Street Journal and then South China Morning Post reported that the U.S. and China have been discussing a Trump-Xi summit in the second quarter of this year. And Wall Street Journal proposed a date in June, and South China Morning Post is even more aggressive, predicting a summit in April. But I think at this moment, there's still a lot of uncertainty in this talk. As a Bloomberg story suggested yesterday, this tariff talk currently is stuck at a lower level, lower staff level. And we haven't seen the momentum picking up between US and China preparing for a presidential summit. I previously worked in the Chinese government, and especially in the foreign service. I understand that in order to prepare a big presidential summit, it takes at least 2 months time for the diplomats of the both sides to sort things out. So in that sense, this April summit seems quite unlikely in our perspective. But there's some truth in the June summit, because previously, when China's Vice President Han Zheng visited Washington and participated in Trump's inauguration, it was reported that he handed over an invitation letter to Trump on behalf of Xi for Trump to visit China. Sometime this year, it was speculated that the timing on the Chinese side was June. There's another interesting part of this story, because the birthday of Trump and Xi will both come in the middle of June. Trump's birthday is June 14th, and Xi's birthday is June 15th, only 1 day apart. So maybe they can celebrate a birthday party together. So that's speculation from the financial market. Anyway, Trump is Trump, so he's unpredictable. We cannot rule out that this big presidential summit to happen in the second quarter. I would say there's maybe better than even odds, maybe slightly more than 50% chance that this big summit will take place. And I think in terms of timing, June is more credible than April.
No, that's very interesting. I didn't realize that they were born 1 day apart, maybe not in the same year, but at least in the same month. And Trump could mean Beijing celebrating his birthday. Interesting. I think that could become a topic of some betting, I would say, in some of the betting markets. Brandon, coming back to you, Xinxin talked about Mar-a-Lago. I think that's the chatter in the markets. Is Mar-a-Lago going to be there for real? And for our listeners, just a little bit of background. Stephen Mirren, who's been chosen to lead the White House Council of Economists. He's a strategist with Hudson Bay Capital. He's come up with a paper, and the paper is titled "A User's Guide to Resetting the Global Trade System," a user's guide to restructuring the global trading system. And one of the arguments that he makes in his paper is that as a result of this free trade, the US dollar has been quite strong. US has been providing reserve assets to the rest of the world, and he's used the concept of Triffin goods in the context of reserve assets, and he's basically arguing that one of the ways in which US can get back, or rather reduce the cost that it has been incurring for being the reserve asset provider for the rest of the world, is to reset the global trading system. And also systematically depreciate US dollar versus some of the major currencies. So I think that's probably one of the trigger points for the markets to discuss a potential for a plaza-style accord being struck at Mar-a-Lago, where the countries will systematically work towards depreciating the US dollar. To be fair, US dollar has depreciated a lot over the last 2 months. I think partly in anticipation of something like this, but also partly because the US economy seems to be now seeing some signs of weakness, meaningful sign of weakness, and markets are pricing in that. So, Brandon, to you, how much sympathy do you have for these arguments, and do you think that is this paper kind of driving the administration's thinking about how to go about resetting the global trading order? And do you think that the argument of trade and the reset of dollar lower will eventually help US in terms of gain its manufacturing competitive advantage, or in some senses reduce the cost of being the reserve asset provider?
Sure. So this is quite a complicated one, and I think it's important to talk about the tensions for trying to do something like what Moran's talking about. So with Trump, you would have to be able to always explain what you're doing in a simplistic way to the voting public. Like, why are you doing this? And you need to be able to prepare them for any sort of adverse consequences. I cannot think of a very easy way to explain exactly what that paper says to the average voter, even to a voter with a reasonable amount of education or background in economics. I think saying that this will benefit U.S. exports and manufacturing if the currency is weaker or lower. If you use the word lower and weaker in a context of Trump, that's always pejorative. That's always bad. He's strong. Our country is strong. Our manufacturing is strong. So the dollar needs to be strong. These are all things that are kind of the mantra of the administration. And so to switch and to say that weakness is actually a benefit is just very politically difficult to message or to sell. There's also, it's a very high risk move for Treasury Secretary Bessent if he went to do this. So say he decided to convene, central bankers and finance ministers from various countries in Florida to talk about this. If it didn't work out, or they couldn't reach an agreement, it'd be incredibly embarrassing. And it would very much relegate him to a lower level of respect from the president in the cabinet and in the administration. And right now, Bessent and Commerce Secretary Lutnick, who is supposedly the titular head of trade, even though technically and legally speaking, Jamison Greer from USTR is equal to Lutnick. They're in a bit of a competition with each other and for attention from the president and for the president to embrace their ideas. So Bessent is there largely to try to sand off some of the sharper edges of the aggressive trade policy, and Lutnick doesn't have a lot of fully formed views that he's held for decades on these matters. So he's listening more to the hawkish people like Stephen Miller and Peter Navarro, and just looking to get FaceTime and airtime with the president. So they're going, I would say both Bessent and Lutnick are on TV and the president far too much than is good for them. And the over-communication and lack of elegance of communication to markets is not great. So because of that internal feud as well, I think if Bessent were to fail, try a Mar-a-Lago Accord, but fail, it would seriously diminish him vis-a-vis Lutnick. So that's another reason for long-term self-preservation that I think that it's unlikely. Additionally, it would, while being difficult to message to Trump's core base, it would also be challenging for the kind of media elites, because when they travel abroad for their vacations, everything would cost more. When they go to buy imported wines or foodstuffs, it would cost more. And one important constituency that we shouldn't forget about is farmers. So when they go to buy fertilizer, most of the components for the fertilizer come from abroad. That would seriously change their cost mix about how much they could charge for their products. And if we're already doing tariffs on potential agricultural imports, or other countries are retaliating against U.S. farmers, any additional pressure on farmers would be very politically damaging for President Trump. So I think there's a lot of reasons why it works in theory, but I think that paper was written largely as a job interview to show a really creative way to be in agreement with some of Trump and Bessent's ideas, but to show his kind of uniqueness and sophistication in that regard. So I'm skeptical that it ever comes to pass. It will be also difficult to get a lot of countries to probably join in, particularly the European Union. Japan, maybe more likely, or China, as Xinxin said, if there's a larger deal, they could be involved. But getting multiple parties to the table, I think, would be very hard.
So, thanks for that. Let me just ask you also this question that, multiple arguments have been given for imposing tariffs. And one of the arguments that seems to have gotten Trump's ear is that we can raise money by doing tariffs. It's as simple as that. You got to do tax cuts. Your fiscal is in a bad position. Here's a way to raise money, right? So between trying to, in some senses, balance the current account, which is at 3% of GDP, with the large current account with countries like China, Canada, Mexico, and even EU, and simple objective of I want to raise money to pay for my tax cuts. Where do you think Trump is where is the logic more sort of acceptable to him?
I think Trump largely uses the revenue aspect as a rhetorical and political tool. Any revenue from tariffs that are imposed in the next few months will be definitely useful for as a pay for, it's called, to offset tax cuts. We don't expect that the tax legislation will actually come to fruition until the fourth quarter. And I would say closer to American Thanksgiving, which is in November, or Christmas in December. It's on a very long time horizon. And anything that the members of Congress are saying publicly right now is just absolutely unrealistic. I think the imposition of tariffs and the collecting of revenue will be helpful in Republicans selling the tax package. But the 232 tariffs that I was talking about earlier on national security goods, if those are actually working, you will see a burst of revenue in the year 1 and 2, and then it will be decreasing dramatically over time, because those are meant to be permanent. As corporations change their behavior and open factories in the US, you'll get fewer imports and a decrease in revenue from that component. Similarly, for the reciprocal tariffs, you could see in the first few months a surge of revenue for the Treasury. But as countries decide it's just better to lower to the U.S. rate and avoid this sort of confrontation altogether, then that's beneficial. As I said earlier, the one caveat is if the U.S. goes completely all the way in the most aggressive posture possible with VAT and has a double-digit tariff on any country based on non-tariff barriers, that's a different story. But I'm not convinced the U.S. economy can weather that for the long term. So,
yeah, Xinxin, you talked about in the event there is a deal, there is going to be a geopolitical angle as well, right?
Yes.
And you mentioned South Asia. We all know that Taiwan is the key strategic target for Xi Jinping. I think the unification between PRC and Taiwan is something that they would like to do. And I think there is some conversation, there's some chatter that there's a timeline to that. Maybe it's 2027, maybe it's 2028, who knows? Clearly, that seems to be an agenda. So from a geopolitical standpoint, right, and given the fact that Europe is effectively seeing a big bloody war after a long gap, right? The European governments seem to be very, very concerned about their security aspects, I think. So between US and China and Taiwan angle, how do you think this plays out in this, from the context of a trade war and a deal? Is China going to look for, in this deal, a sort of implicit blessing or implicit acceptance of US to take back Taiwan or reintegrate Taiwan with PRC?
Great question. From China's perspective, economically, Trump 2.0 will likely cause a lot of pain and difficulty to China. We have already seen the recent escalation in the tariff war. But geopolitically, the Chinese officials, including the top leadership, believe that Trump 2.0 may offer China more opportunities than risks to advance their geopolitical interest. As you mentioned, the reunification with Taiwan is a critical part of President Xi's geopolitical ambition or his China dream, or to make China great again. So Xi and other CCP, the ruling party leaders, are clearly watching the current situation, the war in Ukraine, and also Trump's territorial claim over some other neighboring countries, such as Canada, Panama Canal, and Greenland. And at this moment, they tend to believe that this goal of reunification with Taiwan is more likely to be advanced, to be realized under Trump than under other U.S. presidents for the following factors. The first one is that the Trump's territorial claim over Greenland, for example, is legitimizing China's move, its potential takeover of Taiwan, because compared to the relationship between the U.S. and Greenland, between China and Taiwan, there's a much stronger cultural, language, and historical ties. So this is the first reason. The second reason is that Trump's foreign policy is extremely pragmatic, and is always seeking to make deals. And she is willing and ready to pay a high price. It could be an economic deal to buy Taiwan back. This is the second factor. The third one is that Trump seems less concerned about human rights, ideology, democracy, or the interests of the U.S. airlines than the past presidents. So we have already seen this latest development between U.S. and Ukraine. So it seems that this is also an opportunity for China to take a more aggressive approach to take Taiwan back. So let me put it this way: if Zelensky's government is coming to the deal to end this war in Ukraine, in Russian terms, the Xi's government will be emboldened to take a more aggressive approach against Taiwan within the next 4 years.
Yeah, so I think that's something which we will certainly watch out for. Brendan, coming back to you, there are two ways this trade war can go, right? One, it's everybody sort of becomes aggressive, and it's a tit for tat game, just as we've seen some bit of China and Mexico. I mean, politically, nobody wants to look weak at home, right? So there's a big danger in this that it does become a tit for tat game. Reciprocal tariffs is the reality, and there is a severe damage to the global trading system and the supply chains, right? So clearly there is a big cost there that not just the US consumers, but the world as a whole ends up paying. The second is that this is, again, as a negotiation ploy, and it kind of pushes the rest of the system, particularly the high tariff countries, to relook at what they're doing. In the process, it brings down the effective tariff rates that these countries are imposing on US goods. And I guess you can't just bring down the tariff rates on one country. You have to, except for bilateral trade agreements, you have to then generically lower these tariffs against the rest of the world as well. So we have quite the opposite effect, which is basically the effective tariffs across the world actually come down as a result of this war. Which side of the coin would you choose?
Both.
Both.
Okay, which is maybe not helpful, but at least is probably an outer consensus answer. So yeah. I would say the 232 product-specific tariffs, steel, aluminum, semiconductors, autos, etc., those are very much non-negotiable. We could see maybe a country getting an exclusion or a company getting an exemption or something for a very, very specific national security-related reason, and that'd be like, a Japanese or South Korean firm with which the U.S. is looking to do some sort of shipbuilding or building some sort of jet or satellite or something like that has some sort of importance vis-a-vis China. You could maybe see that happen. But broadly speaking, and for the next kind of few weeks or months, I think we're just going to keep seeing the implementation of those 232s, and that is meant, so that's a negative and permanent feature over the duration of the administration. That's not meant to incite to bring a negotiation. However, the dovish version of reciprocal tariffs, that is to get negotiation, and that is largely to bring down the overall effective rates on a country-by-country basis. And by the way, the U.S. could care less if other countries decide to offer that lower rate to everyone in accordance with the WTO and the MFN, because China and the U.S. haven't cared about the WTO really for quite a long time in terms of its actual practical applications to policymaking. That's my argument, at least. So I think it's time for the rest of the world to also wake up and just stop constraining themselves in that regard. So that shouldn't necessarily be a constraint upon any sort of deal making. So yeah, and then finally, I think the other tariffs related to on different countries across the board, that will very much depend on Trump and his personal animosity with other leaders. So I think the Mexico and Canada tariffs will eventually see them replaced with 232s and reciprocals being more important, and there's a potential that Trump starts a new 301 case against the European Union. That's a distinct possibility. At least they would have more solid legal foundation, and I think people would be able to plan ahead for that. So I think it's going to be a mix of both sides of the coin. Permanent things that are meant to be that will be detrimental and disruptive. Other things that are meant to bring a negotiation.
So again, it's not very easy to figure out how these things play out. But Xinxin, from your perspective, if you were to look into the crystal ball and forecast where will we be about 12 to 18 months from now between US and China, what would be your best guess?
Well, we have to incorporate this factor of the trade negotiation or trade war between U.S. and China in the bigger picture of geopolitics. As I mentioned, China believes that Trump 2.0 will be a strategic opportunity for China to take over Taiwan. So I think for the next, I say 3 years, our baseline scenario is a Cold War, economic Cold War between U.S. and China, and a potential military conflict or even a hot war, or it's like could be a blockade from China to Taiwan. And I think that geopolitical risk clearly is on the rise. And for all the investors, we need to keep that risk factor in mind. And in terms of this, the trade negotiation, from China's perspective, if Xi and Trump have a chance to reach a so-called grand bargain agreement, the geopolitical part must be a part of it. I think for that to happen, both sides needs to be prepared for a long and difficult negotiation. I would say this upcoming potential the summit between Xi and Trump is going to be the beginning of this long process of negotiation between U.S. and China.
No, that's very helpful. We've kind of run out of our time for this conversation. So given the fact that we have 1 hour and we have a whole lot of people on the call, let me just pause here and see if there are any audience questions that we would like to talk about.
There are quite a few. There's quite a few. One's from Aman Sinha from Jindal Steel and Power. Sorry, and from Prashant Jain of HCL Tech. How should India navigate this trade war? What's at stake for us? Where are we weak? What does the US want from us? Where do we have leverage? And we've been talking for a long time about de-dollarization. The USD is over. Does this sort of segmented trading and financial system spur that trade over time?
Brandon, you would like to?
Sure. I think there's every chance that, and I know there have actually been negotiations between India and the US already on reciprocal tariffs. So I think India is definitely one of the countries that will be on most products, not every product, but on most of them, willing to play ball and willing to lower tariffs in order to avoid something that's far more pernicious. I know that Modi and Trump get along quite well, and so that's very beneficial. Leader-to-leader interaction is key to set the tone for the staff to negotiate these things. And as we saw with Canada, if it doesn't have if there's not a good relationship, it can spiral quite quickly. And then on de-dollarization, just very briefly, I would be very circumspect if I was another country or advising another country on looking into de-dollarization, because Trump is very acutely aware of that, and I think he would have no problem imposing across-the-board tariffs, like similar to Mexico and Canada, on every product from a country if they were to really actively start pursuing that. So it's something to maybe think about and talk about in hushed tones, but to do anything that's very public-facing that would come to Trump's attention, I think is playing with fire.
Interesting.
May I add one point?
Yeah, please.
Yeah, I think from Indians' perspective, India is unlikely to be a main target of the U.S. tariff war this time. And in the first round of the trade conflict between U.S. and other countries, especially China, the experience from those countries is this is the big fight between the two elephants. So you want to high low and stay away. So you try to be as low-key as possible, and don't get Trump's attention in this big tariff war. I think that's the first advice I can give to Indian investors. And the second one is that if this economic decoupling is irreversible and inevitable, and it will create winners and losers. For example, a lot of these multinational companies have to restructure their supply chain by moving out from China into some other economies. And in that sense, I think it's very likely that the Indian economy will become one of the winners. And try to be prepared to take the opportunity and absorb those industrial capacity as much as possible. That's another piece of advice I can give to India.
Thanks. Our next questions are from. Our next question is from again two people. Bharat Rohra from Avance Financial Services and Sridev Ganju from L&T. So far, we've been talking about economics driving geopolitics. What about the alternate view, of great power cycles or great power rivalry coming in where value chains are being fought over and that's driving the economics? What mix of this do you see as of now? Xinxin, I suppose that should go to you.
It's an interesting question. There's definitely the cycle of the great power, the rise and the fall of the great powers, but it's a long cycle. And it's definitely much longer than the business cycle or economic cycle we have experienced over the past decades. And many people call the 20th century as the American century, especially after the World War II. U.S. has become the undeniable the superpower of the whole world, and even though people tend to believe that China is on the rise and may challenge the U.S. power and become another superpower, I would say that catch up process will take a long time. And if we use the GDP, the dollar denominated nominal GDP, to measure the economic powers of the both countries in U.S. and China, that gap over the past 3 and 4 years is not narrowing; it's actually broadening. And because during the peak of the COVID, the share of China's GDP in dollar terms was about 75% of the US GDP. But over the past 4 years, that number has declined by almost 10 percentage points to around 65% of the US GDP. That is another reason why President Xi and also China Central Bank are reluctant to have a major RMB depreciation, because they want to have China's GDP to catch up with the US GDP at some point in the future. So this is only one of the measurements, one of the indicators we can use to look at this competition between US and China. But I think for China to catch up and even surpass the US power, no matter whether it's the economic power or the military power, financial power, is still a long way to go.
Thanks, Xinxin. We next have a question from Bhavik Shah of Tata Steel and from Hemant Ajmera of IndusInd Private Equity. The gist is that trade wars are going to hamper global growth. You will have an output loss globally. The US and China are very powerful. So who will really bear the brunt of the output loss? Will it be the US, China, or smaller countries? And who among the smaller countries do you think it'll fall upon?
That's another interesting part. And so let me give my quick answer, and maybe Brandon can also chime in and offer his answer. As I just mentioned, this US and China decoupling is one of the dominant themes in the future development of the global economy. This is a reverse process of globalization. And a lot of these economic players and multinational companies have to adjust their investment strategy or corporate strategy. So as far as we know, over the past 5 years, many multinational firms have already developed a strategy called China Plus One. Basically, that means for all the production capacity and supply chain in China, they want to have at least one other country as a backup plan. If some big geopolitical conflict or crisis takes place between US and China, at least they need to have a plan B, to continue to produce their products and do their business as usual. So that's a a very important theme for the international capital flow and the business development. And in that sense, it's inevitable that many manufacturing firms will be leaving China and seek another destination. I would say some of these countries clearly have already become the winners over the past 6 years since the previous round of the U.S.-China trade war. We have already seen this the transfer of trade from China to some Southeast Asian countries like Vietnam or Indonesia, Mexico. This is another one, and South Asia. In this case, is India and Bangladesh, maybe to some extent Pakistan. They have already become the winners of this restructuring of the global the supply chain and the deglobalization. And I think this ongoing trade war will reinforce this trend because it's unrealistic for U.S. to take all this manufacturing capacity back to U.S., especially those low-end, the labor-intensive industries. So there must be somewhere else those international companies have to focus on. And I think in that case, those emerging market countries with a stable political environment and good economic and political relationship with the United States probably will be benefiting from this trend. And I think India is definitely one of the major candidates.
Okay.
I would just add quickly, the countries with the biggest problems are going to be U.S. military allied countries and the companies within those nations that have a lot of trade with both the U.S. and with China. They're going to be forced to make a choice, and I think their domestic government may get involved because part of the transition we haven't talked about, because it's more, I guess, Europe or East Asia specific, would be, the U.S. security umbrella that it provides globally. That's going to come with mandates, and some of those mandates will be to choose the U.S.'s side in the decoupling economically with China. So, like German companies or other European companies or Japanese firms that are involved in China, that's going to be an issue. Comparatively to other parts of the world where there's no explicit military arrangement.
Tanay, if I can just add my 2 bits on this, I think I broadly agree with what Xinxin has said. I think some countries will definitely stand to benefit, but I generally feel that there is not going to be any clear loser or winner of this game. I think it's a redistribution. It's a redistribution of power in the world. So we are becoming a multipolar world. So if you're a country who are very strongly aligned with US, obviously it doesn't benefit you. But if you are like India, kind of coasting along, trying to have a balanced relationship across various powers, I think you are in a better spot. Secondly, I think this is going to redraw the supply chains. So obviously the deep concentration that was there on China will actually fragment out. As Xinxin said, there is going to be wider set of countries who will be probably emerge as suppliers to the biggest consumer, which is US. And I think from a US perspective, the fact that they are drawing back from their very expansive role in the world peace and world politics, I think that was costing US taxpayers some money. So they save on that, because if they draw away from the world, they don't have to spend on those wars. So I guess this is a big reset. This is a big redistribution. And there will be pockets here and pockets there where you will see people benefiting, but in general, it's a redistribution.
Thanks. Xinxin, I know you have to leave, and I'm sorry, but please go ahead if you have to. I have one last question for Neeraj, which is one very important from a treasury point of view, and it's been asked by Sujit from Tech Mahindra and Arun Singh Jadeja from Intas Pharma. The DXY has fallen from 107 to 103, but the rupee is still there. What's going on out here?
Yeah. Before I answer that question, Xinxin, do you need to, is there a time limit that you have, or can we stretch it by another 5 minutes or so?
Yeah, I have another maybe 5 to 10 minutes.
Okay, great. So let me just answer that question. I think one of the reasons why India has not benefited from this, or rupee has not benefited from this dollar strength. Two key reasons in my view. One is that everybody is still waiting to figure out what happens on April 2nd, right? There is a Damocles sword hanging of tariffs on India. And unless and until it becomes reasonably clear that how this thing is going to play out, what sectors are going to get impacted. Remember, India is a large exporter of pharmaceuticals to China, right? So if pharmaceuticals become subject to Trump's tariffs, then you have one important component of BOP which is going to come under threat. Likewise, we export petroleum goods, we export a whole bunch of other stuff. So I think there is a level of uncertainty in the market that probably will linger on until April 2nd. And once the April 2nd story becomes clearer, I think we could see clear direction emerge for rupee as well. The second reason why I think that market is not reacted so favorably so far is because we all know that Reserve Bank has done a massive amount of intervention in the recent past. And that basically means that there is about $100 billion worth of forward positions that Reserve Bank could continue to either roll over or take delivery of. If in any which way, there is going to be some pressure on the fixing dates on rupees. That's kind of keeping rupee well bid at this point in time. And third, if I may add, a lot of the market was thinking that rupee will probably go down to 90 or thereabouts as a result of this move. Obviously, that hasn't happened. But that has also not triggered a wave of selling that the longs should have done once the rupee sort of touched a high and came back. So I think in some senses, we are not seeing a very clear trend reversal that has emerged. And hence, a lot of sellers have not actually, exporters or sellers of dollars have not really participated in this two-way move in that way. I think this all gets resolved in the first week of April to some extent when the Trump's policies on India become clearer. And if by then the dollar continues to stay weakened, I think it could give a window of opportunity for rupee to also do a catch-up on the dollar strength that has happened. Brendan and Xinxin, please add if you have any views on this.
I think India, as I mentioned, in a quite an advantageous situation in this trade war. We haven't seen any country-specific tariff being announced by the Trump administration against India. Maybe this is one of the factors why the Indian rupee has been so stable against the US dollar. Even for China, the Chinese monetary authority, in this case, the People's Bank of China, have been very reluctant to use its currency as a tool to fight back in this tariff war because, number one, they are worried about their financial instability, and a major currency depreciation may cause a big capital outflow. They had that painful experience back to 2015. So that's definitely a scenario they want to avoid. And another thing is that in order to compete with the US dollar, to elevate the status of Chinese yuan, you need to keep the RMB stable against the US dollar. So all the international currencies are supposed to be the strong currencies, not weak currencies. I think in terms of the long-term strategic goal, the Chinese authorities also have some incentive to keep RMB stable. So is the case of the Indian rupee. If you really want to have the Indian rupee as a major currency in the future, you need to avoid the excessive volatility. Now, I think that is clearly the strategy of the RBI as well. So I don't think at this moment there is a huge pressure for Indian rupee to depreciate by a big scale against the US dollar. And we have already seen this market correction in the US stock market and some other asset classes. And clearly, there is a capital outflow from US equity market into some other markets. And I would say maybe in this case, those big emerging market countries may become a beneficiary in this international capital flow.
Okay.
Thanks, and sorry for keeping you for so long.
Yeah.
We've gone over the hour, so let me just end this. Thank you very much, everyone. On behalf of Axis Bank, this concludes the discussion. I would like to take a moment to convey our gratitude to all our speakers for their time and the benefit of their vast experiences. We look forward to our customers joining us soon for the next edition of Treasury Market Talks. A recording will be available in case you wish to have this passed on to your colleagues. Do connect with the relationship managers for help. Once again, thank you for joining us. You may now log out from the webinar. Thank you.
Thank you, Xinxin and Brandon, once again. Really appreciate you joining this call.
Thank you for the
It's our
invitation.
pleasure.
Thanks, Xinxin, Brandon, Neeraj.